Hello, and welcome back to another episode of Market Brief After Hours. It's been a fascinating, albeit turbulent, Wednesday on Wall Street. We are seeing a distinct shift in sentiment, a real tug-of-war between the high-flying tech darlings we've grown used to and the safety of defensive stocks.
It really was a tale of two markets today. You have investors hitting the eject button on technology and AI while simultaneously piling into value sectors. It's the classic risk-off rotation.
Let's get right into the numbers because the divergence is striking.
Absolutely. So, starting with the winners. The Dow Jones Industrial Average actually outperformed the broader market today. It rose about 260 points, or 0.53%, to close at 49,501. That push was driven largely by investors fleeing tech and parking their cash in healthcare and industrials.
But the picture looks very different when we slide over to the S&P 500 and the Nasdaq.
Completely different. The S&P 500 fell 0.51% to close at 6,883. That's its second consecutive daily decline. But the real pain was in the Nasdaq composite. It took a significant hit, dropping 1.51% to close at 22,905.
And that Nasdaq drop is squarely on the shoulders of the tech sector, specifically semiconductors and software. It feels like the AI euphoria is facing a serious reality check.
It is. The technology sector was the worst performing group today, down more than 2%. We are seeing mounting concerns over earnings momentum and, frankly, valuations that have looked stretched for a while. You mentioned semiconductors. Advanced Micro Devices, or AMD, was a major anchor today. They plunged more than 17%.
17% for a company of that size is massive.
It is, and it dragged down the whole neighborhood. Broadcom, Micron, Oracle, CrowdStrike, they all saw sharp declines. What's interesting is the data coming from hedge funds. Short sellers are smelling blood in the water.
Is that right?
Yes, according to S3 Partners, short sellers have booked around $24 billion in profits so far this year in software stocks alone. The market value of that sector has fallen by roughly $1 trillion. It's a very aggressive unwinding of those positions.
It's not just the stock market flashing warning signs, though. We had some economic data today that seemed to spook investors a bit regarding the broader economy.
Right, the private payrolls data. The ADP report for January was a significant miss. Private payrolls increased by just 22,000. To put that in perspective, the forecast was for 45,000, and even December was revised down to 37,000.
That is incredibly soft.
It suggests labor demand is cooling off. Nearly all the job creation came from education and health services. Meanwhile, professional and business services actually shed 57,000 positions. Wage growth held steady at 4.5%, but the lack of hiring is definitely something the Federal Reserve will be watching.
Speaking of the Fed, how did the bond market react to that weak jobs number?
Surprisingly, Treasury yields were pretty steady. There's still a lot of uncertainty about the Fed's next move. The 10-year yield edged up slightly to 4.276%, and the 30-year rose to 4.917%. The 2-year slipped just a bit to 3.559%. It seems bond traders are in a wait-and-see mode before making big bets on the policy outlook.
Let's hop across the Atlantic. While the U.S. was struggling with tech weakness, Europe seemed to have a slightly better day.
They did. European markets were supported by a heavy volume of corporate earnings and some good news on the inflation front. Eurozone inflation cooled to 1.7% in January, which boosted sentiment. The Pan-European Stoxx 600 edged up 0.1%.
And I saw London had a standout session.
The FTSE 100 was the star performer, climbing 0.9% to hit a record closing high of 10,402. That was driven by oil majors and healthcare stocks. Again, that defensive theme we saw in the Dow.
How about the rest of the continent?
In France, the CAC 40 jumped 1.22% to 8,280. Italy's FTSE MIB added 0.66% to reach 46,725. However, Germany bucked the trend. The DAX fell 0.58% to 24,637. The Swiss SMI also had a good day, gaining just over 1% to close at 13,508.
We're going to take a very short break. When we come back, we'll dive into the technicals on Forex. There are some key moving averages being tested. Plus, we'll look at the commodity surge and the specific companies making headlines today. Stay with us. Welcome back to Market Brief After Hours. Before the break, we talked about the equity markets, but there is a lot of action happening in commodities, specifically oil.
That's right. Geopolitics is back in the driver's seat for energy.
Crude prices surged today as tensions involving Iran intensified. There are renewed concerns about supply disruptions in the Middle East.
What are the numbers looking like there?
U.S. crude climbed just over $1.90, or 3.05%, to settle at $65.14 a barrel. Brent crude was up 3.16% to $69.46. It's a sharp reminder that geopolitical risk premiums can return to the market very quickly.
And usually when geopolitical risk rises, people look to gold.
Gold is consolidating a bit after its recent surge. It closed essentially flat, down just 0.03% at $4,944. It's showing a bit of indecision with a doji-like candle on the charts. However, silver had a great day. It staged a strong rebound, up 2.73% to close at $87.39.
Let's get technical for a moment. For our listeners who trade Forex, there were some very specific moves today regarding support and resistance levels. Let's start with the euro against the dollar.
The euro USD pulled back a bit, closing down 0.12% at 1.1804. It looks like some profit-taking after the recent rally. Technically, though, the bullish structure is still intact. The price remains above the 50-day simple moving average, SMA, which is at 1.1721. It's also above the 100-day at 1.1679 and the 200-day at 1.1613. As long as it holds above that 50-day average, the bulls are still in the game.
And the pound?
Similar story for GBP USD. It pulled back from recent highs to close down 0.35% at 1.3648. It got rejected around the 1.3850 area. But again, the trend support is there. It's trading above the 50-day SMA at 1.3453, as well as the 100-day at 1.3382, and the 200-day at 1.3426. Stability above that 50-day line suggests this is just a correction within an uptrend.
What about the yen? We've seen some volatility there recently.
USD JPY had a strong rebound today. It settled up 0.78% at 156.93. The key technical win here is that it reclaimed the 50-day SMA, which sits at 156.27. It's also well above the 100-day at 154.04 and the 200-day at 150.07. If it can sustain strength above that 50-day line, we could see it target new cycle highs above 158.50.
And finally, for Forex, the euro against the pound.
Euro GBP is in a tricky spot. It closed up 0.31% at 0.8648. The critical level here is the 200-day SMA at 0.8647. It closed just a hair above it. However, it's still below the 50-day at 0.8710 and the 100-day at 0.8726. So the medium-term bias is still negative unless it can really break out above those shorter-term averages.
Thanks for that deep dive. Now, let's circle back to the single stocks, the market movers. We touched on AMD earlier, but what exactly triggered that 17% drop?
It was the outlook. AMD issued cautious first-quarter guidance. Even though they forecasted revenue of $9 billion, which is huge, and their margins were in line with expectations, the market wanted more. In this environment, if you're an AI stock, good isn't good enough. Investors are looking for perfection, and cautious guidance was enough to trigger that massive sell-off.
It wasn't just tech taking a beating, though. Boston Scientific also had a rough day.
Yes, Boston Scientific led the losses in the S&P 500 alongside the tech names. The stock slid more than 17%. They projected full-year adjusted earnings below what the market was forecasting. It shows that earnings season is unforgiving right now. If you miss the guide, you get punished.
But there were some bright spots. Eli Lilly continues to impress.
They really do. Eli Lilly shares jumped 10%. They reported better-than-expected quarterly earnings and, crucially, issued upbeat guidance for full-year profit and revenue. In a market hungry for earning stability, they delivered.
And the biggest winner of the day?
That has to be Enphase Energy. The solar equipment maker soared 38%. They delivered strong quarterly results and projected first-quarter revenue well above consensus. A 38% move in a single session is incredible.
Before we wrap up, we have to mention crypto. It seems the risk-off sentiment in tech bled over into digital assets.
It certainly did. Bitcoin fell 4.01% to $73,332. It briefly touched a low of $72,102. It's been a tough start to the year for crypto. Bitcoin is down about 16% year-to-date and is now more than 40.
Caution is the word of the day. We have slowing labor momentum, pressure on crypto, intensifying geopolitical risks in the Middle East, and a clear rotation out of high-growth tech into defensive value. Investors are reassessing those stretched valuations. Heading into more earnings releases and economic reports, the balance between valuation discipline and risk-taking is going to drive the market direction.
A complex landscape indeed. That's all we have time for today. Thank you for listening. If you find this useful, please follow Market Brief After Hours. We'll see you next time.